Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I am the Chief Strategy Officer here at OptionsPLay. And today we have a very, I would say, popular topic for many investors, which are credit spreads. And we're going to talk a little bit about understanding credit spreads and making sure that you have a good understanding as to why these strategies are popular, why they work in certain conditions, and more importantly, how you can maximize profitability with credit spreads. But this is not going to be everything that you're going to be able to master credit spreads, if you will, per se, but this is kind of an introductory start, and I'll point you in the right direction as to what else you need to do, what next steps you can take to kind of gain that mastery for credit spreads for those of you that are relatively new. But before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss during today's session. So we'll start off by just having an understanding of credit spreads for those of you that are brand new, so you have a better better understanding as to kind of what they are and why you should utilize them in your portfolio. We're going to use a bearish trading example here today, simply because we're in a bear market and there are more bearish opportunities, but nothing, but not because of anything else. We'll take a look at kind of with that bearish trading example, what are the potential outcomes, what are the potential risks, what are the potential rewards, and understanding how credit spreads provide you with an edge. And then we'll show you kind of some of the real-time trading signals that we generate here at OptionsPLay, some real signal examples as to why specific opportunities are better than others, and then, like I said, kind of point you in the right direction for next steps. So for those of you that are asking, where is Jess today? She is dealing with a personal matter, so I am taking over for today. She should be back with us here next week. Thank you so much for asking. But the primary thing that I want to have you walk away from today's session is a clear understanding as to what are the best practices to sustainably sell credit spreads for income. Now, before we kick this off, please bring up your chat window here, which is at the bottom of your screen, and please type yes into the chat window if you have sold a cover call before in your portfolio, and please type no if you have not sold a credit spread before or you're still in the learning process. Okay, so I see a fair amount of yeses and a few no's here. So for those of you that are learning, this should be a good first session to kick you off in the right direction and point you for what are the next steps. And for those of you that are trading credit spreads or selling credit spreads right now, I hope that this provides you with insights into how you can maximize credit spreads and how you can actually find an edge with this specific strategy. So let's go ahead and just get into it. How do you think about, growing your account sustainably with credit spreads? From my perspective, there's really 3 steps. And like I said, today we're going to be taking step 1. We're going to show you kind of how to gain consistency and prevent blowups, in steps 2 and 3. But the goal of today's session is to really get a fundamental understanding as to how credit spreads or how you can gain an edge selling credit spreads. So understanding the strategy itself and then understanding how to gain an edge. That's what we're going to spend our time focused on here today. Just so that regardless of whether you're experienced or not, you have an understanding as to why you want to focus your attention on learning and optimizing this strategy. Then we'll talk about how you can win more than 50% of your trades, because that is when you're going to find the opportunity to optimize and learn more. Is that when you're winning more than 50% of your trades, you're going to want to invest the time and the effort to do so. There are other strategies that can be profitable, but actually win less than 50% of the time. And I just tend to find that psychologically speaking, a lot of traders have a tough time investing the time and resources in something that wins less than 50% of the time, debit spreads, for example. And then lastly, how to prevent blowups. I see a lot of traders that master kind of step 1 and step 2, And as they start to gain a little bit more confidence, as they start to feel that they get the hang of things, they blow up their accounts. And this usually is because of the rules and the discipline that they have around sizing these positions. And once they blow up their accounts, they kind of lose faith in the strategy and they move on to other strategies or they move on to other services. You know, if any of you can relate to that, please type 1 into the chat window, where you thought you've learned something, you thought you were doing pretty well at it, and then you blow up your accounts or have a sizable loss in your portfolio where you kind of lose faith in that strategy. So we'll kind of point in the right direction as to how you can kind of prevent that, because that's really truly how you grow an account sustainably in the long run. So we're going to start off and taking a look at a bearish credit spread example. And this is one that I pulled off of a report, and I'm going to show you how to access this report this morning. I put this together before the open this morning. The Qs were trading at 307. We know the markets are down a little over 2.5%, or around 2.5% here today. So this was as of this morning. I had to put together the slides this morning, so that's when you're going to see these example as of. So at the time this morning, the Qs were trading around 307. Just a little bit over 307. And what I went out to is the July 22nd expiration date. And what I did is I sold the 308 call options, which are the at-the-money call options. The current price is around 308. And for that, I collected $12.03. Now, if you think about a bearish trade, just outright selling a call option is a bearish trade. By selling the naked call, I'm collecting $12.03. The problem with selling a naked call is that I'm taking on unlimited risk, the same risk that you take as if you shorted the stock, which is unlimited risk. And we've all seen what can happen with names like GameStop and AMC. And I think most investors are not comfortable taking on a position with truly unlimited risk. So a credit spread is really, think about, you know, the point of the trade. The point of the trade is to sell that 308 call and maximize the premium that you collect. But because you don't want to take on unlimited risk, what we do is we buy a 328 call against it and pay $3.87. And when we do that, instead of taking on unlimited risk with this particular strategy, we're able to cap the amount of risk that we take with this strategy, so that if the stock does move in the opposite direction that we expect it to, that we can limit the amount of losses that we take. So the strategy driver, meaning what drives the position, is this short 308 call. And what allows us to have limited risk is by buying the 328 call. And when you combine those two together, that's what we call a credit spread. It's called a credit spread because you collect the credit for the trade. You're collecting $12.03 for the 308 call. You pay $3.87 for the 328. So your net credit on the trade is $8.16. That's how much you collect on this particular trade. That's why we call it a credit spread. Does that make sense? Please type 2 if that makes sense to you. Perfect. So there's a few things that we need to understand with this specific strategy before we can talk about what happens after I sell this credit spread. So first thing you need to understand are the distance between the two strike prices. I sold the 308, I bought the 328. The distance between these two strike prices is $20. Difference between 308 and 328 is $20. Now, because I'm collecting $8.16 out of the $20, my max profit, my maximum reward is going to be the premium I collect, $8.16. My max risk is the difference between the vertical width, which is $20, minus the $8.16, which comes out to be $11.84. And if you look at the max risk, that number happens to be exactly $1,184, because that's the $11.84 that's left of the $20 multiplied by 100, which for each options contract is for 100 shares. That's how I can calculate my max reward is $816, and my max risk is $1,184. So what the distance between the two strikes defines the maximum risk reward, and whatever you collect, The rest of it is going to be your risk. Does that make sense? Please type 3 into the chat window if that makes sense to you. This is a very important concept that we're going to come back to, is the distance between the two strikes, what you collect, and what you can potentially risk, okay? And the third number that's important here is the break-even price. So the break-even price is simply $308, which is the strike price that I've sold, plus the $8.16, which is the buffer, if you will, that I have against this position if it goes against me. And if you add those two numbers together, you get $316.16. So my break-even price on the strategy is $316.16. Okay, so max risk, max reward, and this break-even price. Those are important numbers for us to understand for our next slide. So let's take a look at what happens to the Qs after I sell this credit spread. So obviously 3 things can happen. The stock can either move lower, the stock can move sideways, or it can move higher. And it's important to understand how this strategy performs in all of those scenarios, right? Because right now, let's say I have a bearish view on the Qs, I put on this bearish credit spread, I want to know what I can potentially do. So this is really where the credit spread is what we call a forgiving strategy, meaning if you get the directional view correct, you make your full $816 profit. So if the Qs declines like it did today, you can potentially make a full $816 profit if the stock is below the lower strike price, which is $308 at the expiration date. Full $816. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. So that's pretty clear, right? If the trade goes in your favor, you can make $816. Well, what if the trade doesn't move in your favor? What if the stock just stays at 307.64, which is where it closed on Friday? Or I'm sorry, yesterday. What happens if the stock over the next month and a half doesn't move in and stays exactly where it is? Well, that's one of the best parts about this strategy, is that you will still make the $816 because the stock is below $308, which is the strike price that you've sold. So even if the stock doesn't move, you still make the full profits. So does that make sense? Please type 5 into the chat window if that makes sense to you. So if the trade goes in your favor, you make your full profits. If the trade stays where it is, you still make your full profits. And if, let's say, the trade starts to move a little bit against you, but not a whole lot, right? Starts to move a little bit higher, but below the $316.16 break-even price, well, guess what? You still are profitable. This is probably one of the few strategies where you can effectively get the directional view wrong and still turn a profit on this trade. And this is the true forgiving nature part of selling a credit spread, is that if the stock lands somewhere between 308 and 316.16 by expiration date, you will have some profit between $0 and $816. Only if the stock exceeds the break-even price, let's say it's between 316.16 and the upper strike price of 328, then you'll have some loss between $0 and $1,184. And basically, the further you get towards 328, the more you lose. The closer you're around 316, the less you lose. And lastly, only if the stock exceeds the 328, which is the upper strike price that you've sold, do you lose your full $1,184 on this particular trade. Even if the ETF in this particular case climbs to 400 or 500 by the July 22nd expiration, you are limited in your losses to that $1,184. Does that make sense? Please type 6 into the chat window if that makes sense to you. So it's important to understand that in many of the scenarios of what can happen to the market, many of the scenarios you will be profitable. And that's why this is one of the strategies that a lot of people find popular, because you can win more than 50% of the time, even if you get the directional view incorrect. And a lot of people find it difficult to gauge where the market's going to go. So they prefer selling option strategies or trading option strategies that in many of the scenarios, they'll be profitable. Okay, so I think it's easy to understand as to why this is such a popular strategy.
Hey, I hope that you're enjoying the session so far. I would love for you to join me on my next live event, where you can learn alongside thousands of traders, and I'll answer your questions live. Either click on the link on your screen or check out the description below. I host weekly trading and education sessions just like this one, and you'll get to trade alongside our research team's daily trading signals, weekly technical research, and access the most intuitive option strategies analytics platform free for 30 days. We're here to help you succeed, and please make sure you like this video and hit the subscribe button. Thank you, and let's get back to it.
So let's talk about kind of best practices. So I showed you in the first slide that we sold the July 22nd, 308, 328 call vertical because I had a bearish view on the Qs. But why did I choose the July 22nd, 308, 328 credit spread in this particular case? First of all, the target expiration date or the optimal expiration date for a credit spread is 45 days to expiration. This is because we want to maximize time decay, but we want to minimize gamma. Gamma is what works against us in these types of option selling strategies. So if you're long an option, you want gamma to work in your favor. If you are short an option, you want gamma to work. You don't want gamma to work against you. So you know it's fine tuning kind of where do you maximize the different Greeks. So at 45 days, you're going to maximize theta and you're going to minimize gamma. As you get closer and closer expiration, theta does get larger, but so does gamma. And that's what we're trying to find is that sweet spot. So 45 days to expiration is the sweet spot of expiration dates with respect to credit spreads. Now, how do we choose our strike prices? We always sell an at-the-money call or a put. Calls are for bearish strategies. Puts are for bullish strategies. So basically the exact opposite of when you're buying. When you're buying, calls are bullish, puts are bearish. When you're selling, the opposite. Puts are bullish, calls are bearish. So in this particular case, because we're bearish, we're selling the call vertical spread. And we're going to sell the at-the-money call option, which is the current price of the stock. That's why we sold the 308s. And then how do we choose the 328s? The 328s happens to be the 25 delta. And I'll show you on the OptionsPLay platform how you can find these specific strike prices. The most important part of all of this is not the expiration date and strike price selection. The most important part is that you must collect at least 1/3 of the vertical width. Remember, we said that the vertical width is the distance between the two strike prices, which in this particular case is $20. So 33%, 0.33 times 20 is $6.60. We were collecting $8.16. So greatly, substantially higher than the $6.60 minimum that we need to collect on a credit spread. So the most important part is that you collect a minimum of 33%. We're going to spend the next few minutes trying to understand why, and more importantly, how we can gain an edge. But this is really where you can use the OptionsPLay platform for any strategy that you type in. I'm sorry, for any symbol that you type in, right? Doesn't matter. Let's say we're looking at Apple just for a quick example. We now have this high implied volatility strategy that's automatically selected for you. And when you do that, you're going to see both the put credit spread and the call credit spread. Regardless of whether you're bullish or bearish, we will automatically design the optimal credit spread based on these the best practices that I just showed you. So the OptionsPLay platform, first of all, automates this for you on any strategy that you type in. What you have to then do is understand, am I collecting at least 1/3 of the vertical width or not? So in this particular case, the put credit spread, you're not collecting 1/3 of the width because you're collecting $2.80 out of a $10 wide credit spread. That's only 28% of the vertical width. So from my perspective, that's not a credit spread worth trading. In this particular case, on the call credit spread, also same thing, $10 wide because 144 to 155 is $10. And I'm collecting $3.40, which is 34% of the width. So in this particular case, the call vertical spread is potentially worth trading. And especially if you look at the midpoint, it's about 35%. And let's do the same thing here. I'm still collecting $2.80 on the midpoint here. So for me, the midpoint is $2.91. That's still only 29% of the vertical width. So in this particular case, only the call credit spread is potentially worth trading. So even if I'm bullish on Apple, I would not sell this put credit spread because it does not satisfy the last rule of collecting at least 1/3 of the vertical width. Does that make sense, everyone? Please type 7 in the chat window if that makes sense to you. And also the one thing I want to show you here, the reason that we sold the 140 strike is because that's the at the money strike. And then we bought the 130 puts because, as you can see, the 130 puts, it's a 22 delta. That's the closest put option to 25 delta. So if you were doing this manually on your own, you can construct it manually doing the rules that I explained to you, but the OptionsPLay platform automates it for you by clicking simply on the high implied volatility strategies in your OptionsPLay platform. Okay, so that's how you construct a credit spread. But why is this 1/3 rule here? And this is what I want to spend a bit of time walking you through. So I'm going to use nice round numbers, right? Let's say I sold the $100 call option and I buy a $120 call, 120 call. The distance between the two strike prices is $20. And what we said before in the first slide is that this is an important concept because whatever you collect in income, the rest of it is going to be your risk. So if you collect 1/3 of $20, that's $6.67. If you collect the 33%, the rest of the $20 is going to be your risk, which is $13.33. So this risk reward ratio is basically 2-to-1. Basically, for every $1 you can potentially make in reward, you are risking $2 on the back of that. Now, if you trade strategies where for every $1 you can potentially make, you're risking $2, you need to win 67% of the time to break even on that specific strategy. Meaning if you have 2 winners for $1 each, you lose it $2 on the next trade, you win $2, $1 each on the next 2 trades, you lose 1 trade for $2, and you do this over and over again, guess what? You get yourself to a big fat zero, big fat break even. Does that make sense? Please type 8 into the chat window if that makes sense to you. Perfect. And I see a lot of 8s. And a lot of people are asking, why would I trade something that gets me to a big fat zero? And the answer is, I would say that most traders struggle most traders struggle to even get to break even. So the minimum for selling a credit spread is getting yourself to break even. If you can get yourself to break even, that's a pretty big task or accomplishment in itself. Most traders don't ever get to break even. Most traders end up being unprofitable. So getting yourself to break even is a good starting point. So this is why this is the absolute minimum requirement to sell on a credit spread. But in the example that I showed you on the Qs, I found this using our credit spread report, but I found this particular trade because it collected over $8.16, or it collected exactly $8.16, which is over 40% of the vertical width. Because if I'm able to collect, instead of 1/3, let's say I'm able to collect 40% of the vertical width, which in this particular case was $8, then I've reduced my risk at the same time down to only $12. So if I can make $8 while risking 12, for every $1 I can potentially make, I'm only risking $1.50. And this doesn't seem like a big change, but that move from 33% to 40% makes a pretty drastic change. Because if, let's say I have the same winning percentages where I win 2 trades for $1 each, and the next trade I lose $1.50, I win 2 trades for $1 each and I lose $1.50, and I keep doing this over and over again, well, guess what? Now I've reached profitability. So just by finding credit spreads that collect more than 1/3 of the vertical width, I can start improving from being a break-even trader to being a profitable trader. Does that make sense? Please type 9 into the chat window if that makes sense to you. So basically what I'm trying to say after all of this is that at the crux of everything that you've learned here today, what you're trying to do is find credit spreads that collect more than 1/3 of the width, preferably closer to 40%, sometimes even north of 40%, like the Qs example that I found as of this morning. But that begs the question, how do you find opportunities that collect more than 33% of the width, that are more like 40% of the width, 41% of the width, 42% of the width, right? How do you go about doing that unless you're just sitting there going symbol by symbol, manually creating these credit spreads and checking what percentage of the spread it collects? Well, that's really where the real-time credit spread opportunity report that OptionsPLay publishes every single hour comes into play. And there's a few things that this report does beyond just finding credit spreads that collect more than 33% of the width. But that's the first thing it does, is that it scans the entire market and finds only credit spreads that collect more than 33% of the width. But actually, most of the time, we're actually finding credit spreads that collect substantially more than 33% of the width. And that's how I found this Q's bearish credit spread this morning when I was putting together these slides. And I use the Qs because it's a widely held symbol. It's one that a lot of us are watching here today. And as of this morning, it generated a trading signal of to sell this particular credit spread. And if you traded it this morning, you would have had a nice trade as of this afternoon. But what we're here to do is not necessarily tout one specific trade, but to talk about why these trades work. So the first thing the report does is it finds credit spreads that generate more than 33% of the vertical width. So anything that you're looking at, has already a statistical edge in providing a profitable outcome. The second thing it does is it filters based on liquidity. So you're only going to get symbols that are very liquid according to our liquidity algorithms, which means that if you find a trade on the credit spread report, you're going to be able to execute that trade either at the midpoint or within a penny or two off the midpoint. So you know that the pricing that we are showing you are prices that you can actually execute. And the third thing that we do is we align it to our technical directional view. And I'm going to show you what that means in the next couple of slides. But not only are we going to find bearish credit spreads, but we're going to find bearish credit spreads on stocks that we think have a bearish outlook, and only look at bullish credit spreads on stocks that we have a bullish outlook on. So you really just have all of the work that you would normally do to find an idea, which is find a stock with a directional view, find a stock that's liquid enough to trade options on, and then find the optimal credit spread to sell that meets all of the criteria of the best practices that I taught you here today. So this one report takes all of that and condenses that into a single report so that you basically have everything that you need to make a trading decision in that one report, okay? And I'm going to walk you through this report here in 1 second, which is the report. And it's broken down into 4 main sections. On the left-hand side, you have your symbol and the direction. So this is really kind of what stock are you looking at and what the directional view of that stock is. Then the second section is the details, meaning is it a call or a put? Which strikes are you selling? Which strikes are you buying? What expiration date are you trading? What's the potential risk or reward? Meaning what is the percentage of the vertical width that you're collecting? In the Qs example here, we were collecting 41.84% of the vertical width, which is substantially higher than the 33% that we use as a minimum. And then we also have IB rank and earnings. So at the time, the IB rank on the Qs was 59%. And obviously with something like the Qs, there are no earnings because it's an ETF. But if you were trading something like UPS, you'll see that the earnings is on July 26th, which is beyond the July 22nd expiration date. So you can know whether there's an earnings coming up or not in the name that you are selling a credit spread on. And someone just said, this report is my bread and butter. Thank you. I personally spend a lot of time looking at this report when I'm looking for opportunities in the market, because again, it does all of the work that I normally would have to do manually in a single report. It doesn't mean I trade every single one of them, but it just means that this report does all of the work in finding the stocks that align all the things that I'm looking for in the same direction. It doesn't mean that that trade's going to work out. It just means that probability-wise, these are the trades that have the highest probability of success. So what I want to do is spend a little bit of time talking you through the directional part, because I think we've spent enough time talking about the credit spread opportunity part. I think a lot of people understand kind of, collecting more 1/3 of the width, and if you're going to find stocks, credit spreads to collect more than 1/3 of the width, what the benefits are going to be there. But the one part that hasn't been clear to a lot of traders is, how do we align the directional view with that credit spread? So I want to spend a bit of time talking you through what we're looking for on the back end from a directional perspective that even further increases your success on the trades within the credit spread report. So for example, here is XLC, the communications ETF. And XLC had a very nice run from September of last year all the way through September of 2020 through September of 2021. And honestly, at any point throughout this 1 year, if you were to sell bull credit spreads on XLC, you would have been profitable almost at any point. However, that doesn't mean that at any point is the best time to sell credit spreads. I think we would all agree that the parts that are shaded in green from a directional perspective are the most optimal times to enter that credit spread, where you have a big move very quickly on the back of entering that credit spread. So within a week or two of entering that credit spread, you would have been able to collect almost the full premium on that credit spread. Now, if let's say you were bad in timing your trades. Let's say you entered those credit spreads at these times, right? Let me circle some of the worst times to enter the credit spread, right? Which was kind of when it's near the top end of the trading range. Let's say you were entered the credit spreads at any of these bad times. Even in that bad time, in my opinion, you still likely would have ended up being profitable, because it just would have taken you more days to get to that profitable point. But largely as you get closer and closer to expiration, you still would have been profitable. It just would have taken much slower, and perhaps you might have been shaken out because the stock moved a little bit against you initially, and you got scared and you got stopped out before it ended up being in your favor. So I think we all agree that while you had many opportunities to sell credit spreads because of the forgiving nature of the strategy, the parts that are shaded in green are kind of your optimal entries for this particular trade. And vice versa, if we were in the downtrend, if you're looking for bearish opportunities, the parts shaded in red are kind of your optimal entry points for a bearish opportunity. So the parts that are shaded in green are what we're looking for when we talk about a technical outlook or a directional view that is conducive for selling credit spreads. And then the parts shaded in red are opportunities to take a bearish position. So what I want to do is I want to walk you through, this is the report as of this morning. I pulled up the charts for a bunch of symbols here within the report to show you, how we're looking for not only credit spreads that give you this opportunity, but technically speaking on the stock that have a good timing for this particular trade. So let's just take a look at the first one, EWZ. EWZ was the number one scan on this report. It was one of the few bullish opportunities here in this market. And really, if you think about it, what we're looking for in these markets is a pullback in the primary trend, because these pullbacks are kind of your best opportunities to take a quick move that is going to be profitable relatively quickly. And that's exactly what we see here in EWZ. We've had a nice move in the primary trend. We've had a pullback here, and a pullback large enough to statistically give us a better probability of a move here to the upside. So not only did we find, a 33.5, 30.5 credit spread that expires in July, that collects almost 50% of the width, but we also found that technically speaking, it's pulled back enough in this recent bullish trend to potentially look for a move here to the upside. So it's really just a combination of everything that we talked about. Great credit spread, great technical setup for a particular profitable trade. SPY, this was another trade this morning, and But if this was a report from 9:30 this morning, this was before the market opened, and as you can see, this was an opportune time to enter a bearish credit spread here in SPY, because again, in a bearish primary bearish trend, we've had this uptick here over the past few weeks that really has stalled, and this again provides that opportunity here to take a bearish position. The next one I want to take a look at is UPS. Similar type setup. UPS, after breaking down below a major support level here that has held this 190 level for multiple months, is entered a bearish trend. But it came all the way back up to this 190 level, and that is the opportunity now here to move here to the downside. UPS has fired off this bearish signal on this report for many days. For those of you that have spent a lot of time on these reports, and I saw quite a few different viewers here today commenting that you spend a lot of time on this report. If you have, you would have noticed that UPS has been on this report for at least a couple of weeks now, or I'm sorry, quite a few days now, as it kind of stalled in this area. It's been on this report. So you could have sold credit spreads at any point on this. And, over the last couple of days, really, you would have seen kind of the result on this particular trade, because it kind of aligns the timing on the trade with the credit spread itself. Goldman Sachs, also another, the financials have really been on this report recently quite often as well. Same thing here for Goldman Sachs. So actually, I think I might have, this is not the UPS chart. This is the Goldman Sachs chart, or one of these two. Sorry, this was the UPS chart. I didn't update the Goldman Sachs chart, but the Goldman Sachs chart is very similar looking. I'll just pull that up real quick just so you can see here in OptionsPLay. I'll pull up Goldman Sachs. We'll take a look at that chart here together. Goldman Sachs, as you can see, primary downtrend. And what we've seen here is these moves here to the upside are your primary opportunities to sell. Now we have already started a bit to the downside, so you have actually a better confirmation here that Goldman Sachs is not quite here yet, which means that's the most optimal time to enter. You're a couple of days late, but that's not too late to enter. There's still plenty of opportunity here to the downside. But this is really how I go about evaluating opportunities when I pull up this report. And the cues this morning was really kind of that, just near the top end of the range, and from my perspective, provided the best risk to reward ratio of any of these particular charts. It hasn't made that move yet to the downside as of this morning. And that's why, from my perspective, that was the one example that I wanted to show you from today. But you can pull up any of the symbols here on this particular name. Here's Boeing. Boeing also, long-term downtrend here, recently accelerated and had this nice pickup here over the last few weeks. This is really a nice rally of almost over 10% we've seen over the past couple of weeks. Another opportunity here to enter here to the downside. Boeing down 4.5% here today. So, these were all reports that I pulled up at 9:30 this morning, that if you were using this report, you would have seen these opportunities and potentially entered it this morning and have seen a nice performance on it as of today. So I already see a lot of questions here in the chat window. So I'm going to stop here and pause here at this point and just talk about some of the next steps, because hopefully today I've kind of piqued your interest as to why credit spreads is a strategy that you should consider taking a look at if you are brand new to credit spreads. And if you are trading credit spreads, what you should be looking out for and how you can find the best opportunities using credit spreads. So let's talk about how do you progress from this. And for those of you that are saying, how do I get this report? I'm going to show you that here in 1 second. But we spent the time today understanding credit spreads, and hopefully today's session gave you a good understanding of that. The next step is managing trades. Once you're in a credit spread, how do you manage them? I don't have enough time to really go into the details of it, but I've already pre-recorded sessions on this that you can look up, or I'll show you how to access those reports on how to manage these trades, the rules around managing credit spreads. And the third one is, if you're brand new, paper trade these trades. Use the paper trading feature that we have in OptionsPLay. Use the contract calculator we have in OptionsPLay. That's going to help you prevent account blowups. That's really the key next 2 steps in growing your account. So today you've completed step 1, understanding credit spreads. Step 2, managing trades. This is what this link here in your on your screen here will be able to show you. I've pre-recorded this session here that you can use to learn more about managing your credit spreads. I've posted that link here into the chat window, and I posted that link here in the chat window. And then as far as paper trading, I also have sent you a link here in the screen, in the chat window, on how you can use the OptionsPLay platform to paper trade these trades. So those are your next steps if you want to continue your education experience here for selling credit spreads. So let's just take a moment and show you how to access these reports. It's really easy. They are now in your Options Education Hub, which you can find in the upper right-hand corner on your OptionsPLay platform here on your platform. When you click on the platform, there's going to be a link here on the upper right-hand corner that says Education and Resources. When you click on that, you will now see a credit spread opportunity report as you scroll down. We've recently introduced single sign-on, so if you're logged onto the platform, just clicking on the report will load the report. You don't have to sign in again on the OptionsPLay Hub. You can just access the report immediately. This is updated every single hour of the trading day. The last update is 20 minutes before the close, which is at 3:41 here today. And here are all the new opportunities at the moment. There are a few bullish opportunities here, a few more bullish opportunities that popped into the market, especially on some of those really oversold stocks like Square. SLV generated a bullish signal here. Baidu, some of the internet stocks, gold miners. So for those of you that are looking to pick some bottoms here in the market, you have plenty of opportunities to pick bottoms as well. But the majority of the opportunities here in the market tend to be skewing towards the bearish side. But you can access this report here yourself. And if for any symbols that you want to take a look at, let's say IWM, you just click on the symbol here on the right-hand side, and it will bring up the OptionsPLay platform, and you can view the trade within OptionsPLay. Whoops. Let's see, something broke there, but we'll take a look at that. But you can click on the symbol here, and you will be able to view that trade here in OptionsPLay. And this is, or if you want, you can always type in the symbol yourself. Whoops. Oh, I think that's probably why I was signed out. But if you want to just look up a specific symbol yourself, you can type in the symbol, click on the high implied volatility, and you'll see the July 184, 196 call vertical is the one that we were looking at here on this report at the time of the close. And it will also provide you with everything on this report. So you can do it two ways. You can either type in the symbol and click on high implied volatility. That actually gets you the most accurate credit spread to sell because that's based on the latest price, versus this report is generated once an hour. So sometimes you might find a trade that's been stale by about 20, 30 minutes if you're looking at this report, but you can always go on the OptionsPLay platform and find the latest strikes for the current market conditions. So just to show you, as far as paper trading goes, you can always click on the trade button, and we now have a paper trading feature where you can add positions either to a live trading portfolio that you have or to a paper trading portfolio that you create, and you can simply click on add position, and you can view those trades in your paper trading portfolio or in any of your portfolios for that matter. And you can use your tool and say, just show me my paper trading portfolio, and you'll be able to see, in this particular case, your IWM, short 184, 196 call vertical here for IWM in your paper trading feature. But the one thing I do want to show you guys is really kind of position sizing. And this is really kind of arguably the most important thing out of what you're going to learn here today, because today was spent on understanding the strategy itself, but ultimately what defines how much you can potentially risk and how much you can potentially make is the number of contracts that you sell. And that's why we have the risk and investment calculator. And I highly recommend, if you have not done this before, to click on adjusting your defaults in your profile, which is done at the bottom of your risk and investment calculator. And this allows you to set how much you're willing to risk of your total account value. So this defaults to 2% of of whatever your account value is. So you type in your account value and you save this as default. And when you save this as default, I've defaulted this to 2% of a $100,000 portfolio. So when I use the risk and investment calculator, it will always default to $2,000 because 2% of a $100,000 portfolio is $2,000. That should be the maximum I'm willing to risk on any given trade. So every time I'm looking at a credit spread, all I have to do is simply click on the calculate button and it automatically calculates that I can sell 3 contracts of this credit spread on IWM. Or I'm sorry, I'm looking at debit spreads here, but let's look at my credit spread here. I go to risk and investment calculator, I click on calculate, and it tells me that I can sell 2 contracts. Because if I sell 2 contracts, my max risk here is $1,400. That's within 2% of my total account value. If I was to sell 3 contracts instead, guess what? My max risk is now $2,121. That exceeds my max risk. And if you use the risk and investment calculator every single time you place a trade and calculate the appropriate number of contracts, your chances of blowing up your account are going to be substantially reduced. And the number of you that responded to having gained confidence in the trade and then subsequently blowing up your account, there were a lot of you that answered once. The solution to all of that is never getting yourself into a position where you are even at risk of blowing up your account by using the risk and investment calculator. I know someone's asking how much margin is needed on a credit spread. The max risk is your margin requirement on a credit spread because that's the most that you can lose. So your max risk is your margin requirement, and that's how we use the risk and investment calculator to help you stay within your lane and stay out of trouble from blowing up your account by not trading enough contracts to even do so to begin with. So hopefully, and how many of you have used the risk and investment calculator with the new contract calculator? Please type 1 into the chat window if you have used that already. I see a lot of ones already. So for those of you that have used it, great. If you have not used it, again, please go in there and set this up and make sure every single time you place a trade, all you do is just simply click on calculate. It automatically does the work for you. Otherwise, you might find yourself in a position where you are at risk of blowing up your account because you didn't calculate the number of contracts correctly. Okay, so let's now move this over to Q&A because I have spent enough time walking you through the platform, showing you the credit spread opportunity report, talking about credit spreads, and talking about what are next steps. So, and for those of you that are watching here today, if you do not have an OptionsPlay account, you don't have access to the platform, you don't have access to reports, go to optionsplay.com/webinar. You can sign up for a free trial for everything. You'll get access to our daily trading signals. You'll get 30 days to this report, and you'll be able to learn alongside with us on your next steps. So sign up at optionsplay.com/webinar to access these tools here today. So with that, let's open this up for Q&A. There's both a Q&A section and chat window section at the bottom of your screen. Please bring up your Q&A section, and I'll try to answer as many questions as I have time for here today. And by the list of comments that I've seen so far, I'm guessing there's going to be a lot of questions. I'm going to try to get through them as many as possible. Question about debit spreads. Would you ever buy a debit spread that was in the money, for example? Yes, sometimes you will buy a debit spread that's in the money, especially if you want to minimize theta that you can use a debit spread for. You know what? I will leave up this screen up for those of you as I talk about this. Why do you seem to favor debit versus credit spreads? At least with the credit spreads, you make some money. I'm not sure I understand the question. Debit versus credit spreads depends on your outlook of the stock. That determines which one you use. I don't necessarily know that we have a favorite of one over the other. Is that a good risk reward on the Qs? I would say it's a very good risk reward on selling a credit spread, in my opinion, because you're collecting 42% of the vertical width. Can OptionsPlay show premium versus width and comparing different credit spreads? So Alex, that has actually been one of the feature requests, and we're actually in the process of, putting that on our roadmap. Can I use OP app to get the idea of the profit at 21 days expiration instead of just at expiration? So the rules is to exit at 21 days expiration. You absolutely can. You can risk an investment calculator. I'm sorry, you can use the P&L calculator. You can move the date and where you think the stock's going to be. So for example, if you think IWM is going to be down at 175 and you think 21 days to expiration, you can see what your potential profit is. In this particular case, you'll make 68% of the vertical width at 21 days to expiration if the stock is down at 175. So yes, you absolutely can look at what is potential potential risk or reward before expiration. What would happen to this strategy on 0 days to expiration? Well, I guess that depends on where the stock lands up. If it's below your short strike, you're going to be assigned on your option. So this is something that we generally don't recommend, is holding these strategies to expiration. You always want to manage these trades before expiration, and that's part of this step 2, managing trades. So watch this video. I posted a link here into the chat window on best practices to manage credit spreads. Is it better to use on weekly expiration? I'm not sure I understand that. July 22nd is a weekly expiration. If you're talking about 1 week options, this is really where some people like to sell short dated options. We see a lot of investors trading shorter dated options. The risk there is that you have a high amount of gamma, which means that if the stock moves even a little, you can go from a positive, a small gain on the trade to a large loss on a small movement in the underlying stock. You generally don't want that. You don't want this. You don't want a profitable strategy to swing to a large loss in a small amount of time. That will only happen if you trade a 1 week expiration. So that's why we generally stay away from selling short dated credit spreads. Could OptionsPLay automatically show how much is collected? So the credit spread file does exactly that. It shows you how much you are collecting. From my perspective, I don't think it makes a lot of sense to search for credit spreads manually. I only look at credit spreads on this report because it already calculates for me the premium versus the vertical width. When to enter the trade after getting the trade signal? Basically immediately. This report is updated every single hour. So if you see it on this report, you should be entering the trade immediately. Would this report skip the quarterly report dates? I'm not sure I understand what you mean by the quarterly report dates. We have the earnings date here. So if you want to skip stocks that are reporting earnings like ACN here, Accenture here, it reports in 2 weeks, maybe skip Accenture and stick to the trades that are reporting, like Honeywell or, Seagate Technologies that report, well towards the expiration of the trade itself. Why close a credit spread at 100% max loss? Because your chances of losing more than that is pretty high. So you might as well limit your losses here. Please explain the 3 columns under the credit spread details. There's really 3 parts to a credit spread, which, expiry date and which strikes you sell and which strike you buy. So this just basically gives you all of that information. These are wide spreads if it goes against you. So, there's no such thing as wide or narrow spreads. It's just a percentage of the vertical width, because that determines how much you're risking and how much you are potentially making. So it's about the relationship between the two and not the distance, if you will. So what you really care about is the relationship between the two. You can have a very narrow spread, but if you're collecting a very small percentage of it, you're going to be risking a large amount from a percentage perspective. So dollar amounts really don't matter from my perspective, because your max risk is going to be roughly the same every single time you place a trade, because you're going to trade different contract sizes, right? So if you trade something very narrow, you're just going to trade more contracts of it. So dollar amounts don't mean anything. Percentages mean everything. And that's really what we care about here. So if you're collecting something, a large percentage of the vertical width, that's really the thing that matters the most. If it's a wide spread, you're just going to trade fewer contracts. How do you get the real-time signals report in OptionsPlay? So a great question. Again, you find it in the OptionsPlay hub, which you find in the upper right-hand corner in the Education and Resources hub. You'll find it under the credit spread opportunity report within the OptionsPlay hub, or you can just go to optionsplay.com/hub. That's another way that you can access the report, but you would have to log into it after you click on this. If you're in the platform and you click on the hub, you will automatically have access without having to log in again. How many trades can anyone trading full-time using Thinkorswim can take on and be able to monitor, considering 2% of the portfolio per trade idea? How many can you monitor? That depends on kind of your schedule, right? As far as how many should you trade, we tend to find that you probably shouldn't have more than 10 of these open trades at once. With the 2% rule, because then you're still risking 20% of your total account value at any one time. So one bad kind of week, if you will, could wipe out 20% of your portfolio, or rather one bad month could wipe out 20% of your portfolio. And it really just depends on how much of your total account value you're willing to risk in a single month. That determines how many positions you can open up. But theoretically, you can open up substantially more than 10 trades at a time. You're just risking a large percentage of your portfolio. But if you spread it out between bullish and bearish positions, you can hedge that a little bit as well. So I would say the number is somewhere between 10 to 20 open trades at once. What is daily play trade ideas? Daily play trade ideas are the ideas that we send out to you every single morning, that we email to your inbox at 9 a.m. With a specific open and exit trade. Many times we'll leverage credit spreads in those in those trading signals in the daily play trades, but we do a combination of debit spreads and credit spreads on those particular trades. Is the target 50% to close to sell? So we tend to find that if you're trading multiple contracts, 50% works for at least half the position, and then you can keep the other half to hold closer to expiration. But if you are trading multiple contracts, taking half off once you reach 50% is good practice. How do I activate paper trading feature? Winston, paper trading is already activated in your portfolio, but you might have to do is click on manage in your portfolio section. So when you go to portfolio, click on manage, there is the ability to create a new portfolio. So you're going to have to create, a paper trading portfolio first. And once you save that portfolio, you will see it as a drop-down menu when you click on the trade button. So you can create as many portfolios as you want. And then when you click on the trade button, all of those portfolios will show up here under your positions. And you can select the portfolio that you want to add the position to. So if you've traded a specific trade in your live account, and you want to add it to your from a tracking purpose, you can do that. So I have like IBKR, Schwab, and TD set up here, including my paper trading portfolio. When I click on add position, I can track all of my portfolios at once here at OptionsPlay. Winston, your question about time frame and risk tolerance, that's only for credit. That's only for cover calls and short puts. That's not for credit spreads. As a beginner, is it perhaps better to set it at 1% as the max risk? So David, from my perspective, anything under 2% that you're risking as a total percentage of your account value is a good thing to have. If you are more risk adverse, setting it to 1%, totally something you should be doing. 2% is the maximum that you should be risking on any given trade. So if you feel less confident, you're starting with 1%, great place to start, David. What is the criteria to sell the option? Raul, the criteria to sell the option from our perspective are three things. You need to have a credit spread that collects more than 33% of the width. You need to have something that's very liquid, and you need to have something that aligns with your directional view. And this credit spread report basically does all of the work, where all three criteria must be met before they show up on this report. Do you have a video on whether a credit or debit spread is the most appropriate choice? Michael, yes. If you go on youtube.com/optionsplay and simply search credit versus debit, I do have a video on that specifically. Why a 20-point spread? So the spreads are not, the distance of the strikes are based on deltas. We use a probability-based approach to determine how wide the spread is. And effectively, it's based on the volatility of the stock. The more volatile the stock, the wider the spread. The less volatile the stock, the less, the narrower the spread. It's always going to be naturally adjusted based on volatility. How to use IV rank on the report? Generally speaking, people tend to prefer selling stock opportunities that have a higher implied volatility rank. So if, let's say, you're looking at IWM versus SPY, these two are very similar in nature. They're both collecting 42% of the width, but because SPY has a higher implied volatility rank, some people will tend to favor selling the one that's a little bit more expensive, because then you have Vega kind of working potentially in your favor in addition to theta and kind of delta. So it just gives you a slight edge. It's not much of an edge, but it can give you potentially a slightly bigger edge for selling options that have a higher IB rank. Do you set up a stop loss for credit spreads on your trading platform? Yes, I do. I actually have a video on this for those of you that want to look up Thinkorswim orders. I have a video on how I set bracket orders to protect myself and take profits on these types of credit spreads using Thinkorswim. Francisco, thank you so much. I hope that, as you said, that this provides you with a little bit better understanding. So your question about managing it, I highly recommend that you watch my video on managing credit spreads, which again are available to you on the two links that I sent to everyone in the chat window, both on managing credit spreads as well as activating your paper trading feature. Is the strength number applicable to spreads? So the strength number is applicable to kind of the directional view, right? So something with the low strength, meaning these are weak stocks. Something with the high strength, meaning these are strong stocks. There's definitely evidence that relative strength is a factor in performance. So weak stocks tend to underperform, strong stocks tend to outperform. So it does give you another statistical edge, if you will. If you're looking at two similar examples, that the one with weak relative strength is more likely to move further down than the one with stronger relative strength. If you're expecting the stock to go down, is it better to buy a put credit spread or sell a call credit spread? Well, if you're expecting something to go down, a call credit spread is the only strategy. A put credit spread is bullish. So I would not trade a bullish strategy on the stock that you think is going to go down. Does margin cost figure into profit or loss? So margin is your max loss, right? So as we were saying before, you have the relationship between your max risk and your max loss. So whatever your max risk, that's going to be your margin requirement. So the larger your margin requirement, the less you're potentially making. So the lower your margin requirement, the more you can potentially make. So indirectly it does, but I wouldn't necessarily say the margin is really what is the thing that you would look at. Jeremy, you can sign up for a free trial and then you can test it out before you have to subscribe, and you can see the cost on the OptionsPlay website. If you go to optionsplay.com, you can see both the monthly and annual pricing. Why are IB ranks in red? So the higher the IB rank, the better it is for selling. That's why it's red, right? So, lower IB ranks are green. Those are better for buying. Why not sell a 40 delta rather than at the money? So if you choose, you can sell a 40 delta. You're going to find that it's almost impossible to find credit spreads that collect 1/3 of vertical width if you sell a 40 delta. You have less chance of it going in the money. The problem is that we're not holding these expirations. So the chance of it being in the money or out of the money doesn't really matter to us. The only thing that matters is whether you're profitable or not. And what you're trying to do is maximize your income that you collect. The only way to maximize income is by selling at the money strike price. So because you never hold these to expiration or even close to expiration, whether it's in the money or not really doesn't matter. Would it be better to give stop loss as our max gain? Would it be better to give stop loss as our max gain? So we do set our stop loss at our max gain. So 100% of max gain. So I don't quite understand your question, Winston. We never let this run to max loss. How could I download the slides of this presentation? So whenever we post these videos to YouTube, the slides are always in the description. So you can always go into the description and download the slides. What do the different shades of green represent? I think this is a question regarding the credit spread file. Basically, the more you collect in terms of the vertical width, the more green it is. Well, why is 25 delta the ideal benchmark? We've just back tested all the different deltas, and we tend to find that 25 delta is the sweet spot in finding these trades that collect more than 33% of the width. Looks like I've answered most of these other questions here at some point today. We've already gone well over an hour here. I unfortunately couldn't get to all of your questions. There were so many, but I do appreciate so many of you for attending here today and asking your questions. And hopefully I was able to address as many of them here as possible. But once again, like I said, today is the first step in this journey for those of you that are learning, whether you're brand new to credit spreads or you're experienced. Hopefully today gave you that understanding of credit spreads. The next step is learning how to manage trades, paper trading, and making sure that you position these trades appropriately. If you're able to complete step 2 and step 3 and really take this on, that's really where you have the greatest chance of growing your account successfully and profitably using this one strategy and one strategy alone. So with that, thank you so much for your time here this afternoon. I hope that this was helpful and really looking forward to our session here again next Thursday. Thank you so much and have a great evening.